Have you been working on to build your credit, but you feel like there hasn't been that much movement? You've been making payments on time, keeping your balances low, and doing all the right things, but your credit score doesn't reflect that. So, what gives? So, in today's video, I want to discuss why your credit score is staying flat and what you can do about it. What's up, winners? My name is Nam. If you're new here, welcome. Here we talk all things personal finance and credit, so start now by subscribing so you don't miss out on any future videos. Credit scores are way oversimplified than they actually are. You've probably seen this breakdown of your FICO score. The first portion is 35% based off payment history. This is going to be any type of late payments, accounts that went to collections, judgments, and also bankruptcies. The second part, which is 30% of your credit score, will be your credit utilization, or the amounts owed. This is how much debt that you currently have. The next portion is 15% of your credit age. This factors in how long your accounts has been open for. Another 10% of your credit score is based off your credit mix. This is the type of credit that you have currently or previously had. This can be installment loans such as mortgages, auto loans, hard money loans, or revolving lines of credit such as credit cards. And lastly, 10% of your credit score is based off new credit. This one has a negative effect on your credit score. This is when you apply for new lines of credit, also known as a hard inquiry. Even though this graph makes it super simple to understand, but there's so much more that actually goes into your credit score. So let me go over my first key point, which is the optimal amount of credit cards. I have mentioned this previously in my past videos, but it is worth mentioning again. Generally, if you want top tier credit, you will only want to keep anywhere between 2 to 5 credit cards. That may seem extremely low, and I have way more than that. And there are plenty of other exceptions, but having a need for less revolving lines of credit actually shows that you are lower risk. When you have less credit cards, you tend to keep these credit cards for much longer. As I mentioned before, the amount of credit that is available to you matters, so does your credit age. Yes, I know, if you keep applying for new lines of credit, your available credit utilization can be much lower, but your credit age will also be much younger. Typically, you'll see your credit score going down after you apply for a credit card, just mainly due to the fact of a hard inquiry. I always recommend anyone who ever wanted a good credit score and to qualify for the best interest rates, all they really need is a credit score of 740 and above. But as a disclaimer, just because you have a 740 credit score, this does not guarantee that you will get approved for everything. There are other factors that are in the underwriting process, such as your income, your debt, and other recent credit lines. But generally, if you have a credit score of 740 and above, you pass the credit score test. So if your credit score is below this number, I would try to refrain from applying for new lines of credit unless your credit limit is extremely low and you need a boost from a primary trade line. There are rare exceptions, especially for individuals who are trying to build or repair their credit, but for the most of us out there, applying for a higher credit limit has more of a benefit to your credit score. But what about all of these YouTubers who apply for so many credit cards and churn these points? How are their credit scores? Well, I really can't speak for anybody else, but I would imagine their credit score is probably in the mid 750s. It is gonna be very difficult to get a credit score above 800 if your credit is so young since you're always applying for new lines of credit. It actually took me quite a while to break the 800 levels. This actually took me about a year without applying for new lines of credit and paying off a loan to actually get there. So to have an excellent credit score, this generally does take quite a bit of time, but by applying for more credit cards, this just slows the process down. Now this moves me on to my next point, is by keeping lower balances. One surefire way to increase your credit score as quickly as possible is to get rid of credit card debt. I understand that this may be easier said than done for some, but there's really no shortcut around this. If you are carrying a balance month after month, even though you're making the minimum payment, depending on the balance, the minimum payments may not even touch the principal. This goes back to that credit card circle of 30% of your credit score is essentially your credit utilization. This is the amount of credit available to you and how much of it you use. The general concept is to try to keep this below 30%. Obviously, the lower the better. I would say 10% or less will be optimal. If you are having some trouble with credit card debt, you may want to consider a debt consolidation loan. This essentially can be any type of loan, but the interest rates are generally going to be much lower than your credit cards. Since this type of loan is a different type of financial product, once your credit card balances does get paid off, you will see an instant bump to your credit score. A debt consolidation loan will add to your credit mix, and as this loan gets paid off, your credit score will start to trend up. One common question I do receive is credit utilization based off one card or overall. According to FICO, they look at both. That's why your credit score is not set in stone and it could be way more complex. Let's just say that you have 5 credit cards and each one of them has a $1,000 credit limit. If 4 out of 5 of them have a 10% utilization, but one of them is at 90%, that one card at 90% will bring your credit score down. It may not bring your credit score down if you have 30% across all of your credit lines, but a single card with a high utilization will have an effect. So let me give you another example. Let's just say that you just bought the new PlayStation 5, which is roughly around $500, but plus tax, this will cost you around $600. If you have a credit limit of $1,000, buying that PS5 will make your credit utilization go up to 60%. That right there in a creditor's and lender's eyes will make it look more risky. So before the statement balance is reported, prepay some of that amount. Pay $300 of it right away, so when it gets recorded to the credit bureaus, it only shows that you have a $300 balance and your credit utilization will only be 30%. I do go more in depth with this particular strategy in a previous video, so you guys can see it up here or linked down in the description. Now let's keep it moving with closing accounts. We all know that keeping your accounts open as long as possible has a great benefit to your credit score. But I understand that life happens and you may miss a couple of payments, so you try to dispute this information as incorrect and you decide to close your account. I have seen this time and time again. If you have an old account with some negative information, so you try to fight it, and if unsuccessful, you close the account because you're mad about the service. This is where you need to swallow your pride. Even if you were behind on payments, anywhere between 30 to 90 days before it goes into collections, try to be as current as you possibly can moving forward. Of course, this would matter much more if you had the account open for a couple of years rather than something that you had open within the last few months. But either way, having late payments on an account that's open or closed, it still affects your credit score. You could try to send them a goodwill letter, but if they still refuse and the account is worth keeping, then keep it. Because once you close it, those late payments will still affect your credit score unless somehow you're able to do your own credit repair and dispute this with the credit bureaus. As a shameless plug, if you guys are interested in credit repair, I do offer services, contact information in the description. But let's just say you have an account that's in good standing, but you seem to rarely ever use it. Your account then may be closed due to inactivity. And once this happens, this will have a negative effect on your credit score. So this is going to take a bit of time for your score to get back to where it once was. One of my older accounts closed due to inactivity without any notice. I just see it hit on my credit score when I woke up. Another harmful thing about closing accounts is that this lowers your overall available credit, which requires more planning to keep your credit utilization low. This moves me on to my next point, which is negative marks on your credit score. Generally, negative marks that are more recent will be more damaging to your credit score rather than something that happened 6 years ago. Because let's take a look at it from the lender's eyes. If someone was recently late on the credit card payment, they have a higher chance of becoming late sooner than later. This person may have just forgotten or they are facing financial hardship. Late payments really don't have any rationales attached to them. On the other hand, if someone had a late payment 5 years ago, but there are no other negative marks, then they have redeemed themselves. Depending on what the credit scoring model that the creditors and the lenders look at, recent information will have more significant impact on your credit score. All you can do at this point is either try to dispute it or wait until time does its part. The majority of negative items fall off your credit report within 7 years and possibly up to 10 years. Now this moves me on to my next topic, which is errors on your credit report. Depending on what statistics that you look at, it is reported there's roughly around 50 to 70% of credit reports have errors on them. That is incredibly high. If a bad item gets reported on your credit report twice, your score can be much lower than it should be. So let's just say that you went through a bankruptcy. This is the absolute worst case scenario. All of the things that you declared should have been included. But if you are still seeing negative accounts that are still on your credit report, this is a doozy to your credit score. A bankruptcy already has a significant impact on your credit, but getting more tallied on will make it more difficult for your credit to grow. Another situation is that if you have a common name, you may see incorrect information reported more often, such as incorrect addresses or debts. So it is best to review your own credit report at least once a year just to make sure nothing's out the norm. Nowadays, everybody has a credit tracking app, but they don't go into as much detail as if you were looking at an actual credit report. When it's all said and done, there could be multiple factors that's keeping your credit score stagnant or low, whether it be your credit history, your utilization, or any other recent marks that shows on your credit report. The thing with credit scores is that it takes a lot of patience and persistence for it to grow. It can take anywhere between 30 to 60 days for information to reflect your credit score. If you guys haven't already, make sure you give this video a like. It really helps support the channel. I'll see you guys in my next videos.